If you have a track record in self-storage in Florida, but then you're pitching a multifamily deal in Texas, that's usually not a great fit.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Rob Beardsley of Lone Star Capital, who is one of the brightest minds in the multifamily real estate business. He's someone who has achieved ridiculous success, really by his mid-20s. I mean, just what he's done at his age is actually incredible. Acquired over $350 million worth of multifamily real estate, all in Texas. And he's built an incredible business alongside his business partner, Kent. And they are known in the business as some of the best Texas-based multifamily operators, really just in the game right now. And in this episode, we chat about how Rob is structuring debt and structuring equity in general, and how he's putting deals together at this point in the market cycle, in early 2023 or heading into mid 2023 now. We also talk about critical underwriting changes that he's making. We talk about some of the things he's learned along his journey as it relates to making sure that you raise capital before you get a deal under contract. And we talk about their thesis, why they like Texas, why they're hyper-focused on one specific market, why he raises capital from all kinds of different investors, whether it's retail investors, professional investors, joint venture equity partners who are writing big checks, co-GPs, fund of funds folks. So really tactical, high-level conversation. He's, again, like I mentioned, one of the brightest minds in the business, and he's the author of a couple of really great reads. I believe one of his books is called Structuring and Raising Debt and Equity. The other is The Definitive Guide to Underwriting Multifamily Real Estate. Both of those books are very quick reads, and they're extremely informative. Like, just no fluff, just playbooks on how to think about both of those topics. So highly recommend you buy his books. I mean, it's some of the best money you can spend. It's just like incredible value. But outside of that, obviously listen to this episode as well, because you're going to learn a number of things, I guarantee it, especially if you're somebody that is trying to buy large multifamily, raise capital, vertically integrate your business, focus on one market, et cetera, et cetera. So be sure to stick around and give this episode a listen. And if you find some value in its contents, please consider sharing it with somebody in your network, whether that's over email or over text, or throwing it up on LinkedIn or Instagram, or however you want to share it. Helps the show get noticed by more folks, and I always appreciate it because that's how we grow this thing. But let's get to this week's episode with Rob Beardsley. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me today is Rob Beardsley, who is a young multifamily investor. He's an author. He's actually one of the brightest minds in the real estate business, I would say. Somebody who's written two great books about structuring deals, raising debt, raising equity. Someone who's at the forefront of a lot of these conversations in the multifamily game. So really looking forward to this episode. But Rob, why don't you start with your story? Talk about how you get into real estate, and in your words, what your business looks like now.
Sure, that sounds great. Yeah, thanks for having me on the show. So my business partner and I, we started our company, Lone Star Capital, about 5 years ago to focus on owning and operating Texas workforce housing. To date, we've acquired over $350 million in multifamily assets, primarily in Houston. And we also, a couple years ago, launched our in-house property management company, Radiance Living, which is also based in Houston, which manages our entire portfolio and only our portfolio. So we don't do any third-party management assignments. So that keeps us vertically integrated on the construction and management side, and very focused on our assets. So that's pretty much our business plan today. Prior to forming Lone Star, I was working in my family's business. My family has a background in residential real estate back in Silicon Valley, California. So my parents bought and sold homes for their clients, and also did some fix and flips and development of single family homes on the side as well. But about 7 years ago, my family got involved in multifamily after I was in college, just kind of doing my own research on the real estate market. And I fell in love with multifamily as a business model, as an investment strategy. And, we did some smaller investments as a family, and then we branched out to wanting to do our own deals. And unfortunately, my parents were still too busy with their main business. So I branched out on my own, met my business partner Kent, and that's how the company Lone Star was started.
No, that's great. It's a hell of a story. And you've done a lot in 5 years, like without a doubt, especially starting from, more or less zero, right? In terms of in the multifamily game, just going from zero to 350 million in that time period. That's pretty rapid growth. Let's start with Texas. How did you decide on Texas? You guys are hyper focused on Texas deals. A lot of folks come on the show, they talk about how they're in this market, that market, and they're a little bit more spread out, but I mean, you guys have been really laser focused on Texas and specifically Houston. I know you have deals outside of Houston, but what led to that decision-making process? Why Texas, and then why not other markets? And just in general, why'd you kind of narrow your focus down to that level?
So at the very beginning, I had this notion that the more markets I look at, the more deals I look at, the more deals I could buy, right? That just kind of makes logical sense. But what I found is that's actually not true. And it's a fallacy. And it's actually funny because if the fewer deals you look at, the fewer markets that you look at, it's actually the higher likelihood of success to actually making a deal happen. So I didn't learn that until a little bit later on, because initially I was just grabbing any deal I could find in any market and I wanted to see if something could work. But later on, my business partner and I, we were in Joe Fairless's mentorship program, and Joe and some other people in the group were very big on Texas multifamily, as many other people are, right? Texas isn't a secret. So that's kind of what it was, the initial attraction. And so we were looking around Texas at the major markets, and we felt that Houston was slightly less competitive, and we were able to get our first deal done in Houston. And then from there, we were off to the races. And it made, at that point in time, solidified the decision to actually focus on Houston rather than look all around Texas. It's tempting to look at new deals, of course, and think that the grass is always greener. Oh, well, maybe there's better deals in other markets. But the reality is you have to stick to it. You have to stick to the markets that that you have good relationships in, and where you're able to actually build a reputation and some scale. So we didn't really start out with this master plan of focus, but it really has become a cornerstone of our business, which has allowed us to, like I mentioned, build good relationships, vertically integrate, because if you don't have a clustered portfolio, you can't really bring property management in-house and have your people on planes everywhere. So that has been a major factor, in my opinion, of our success.
No, and that makes a lot of sense. And I've talked about on the podcast before, because we're in two markets, but we're very, very hyper focused on those two specific markets. And I like to say that narrowing your focus like removes ambiguity around what you do in the marketplace. And when you become associated with a specific geographical area, the market knows what you want, right? They know what to send you, whether it's brokers or lenders or just investors, right? Whether they're sending you deals or money, they understand your zone of genius, where your competence lies. And by actually narrowing your focus and developing a deep expertise in one specific asset class or geographical area, you actually set yourself up for more success, which I think a lot of people stumble backwards into. It's hard to really grasp that concept early on. And I would put myself in that boat, but eventually you find that. Now talk about your business partner, or I should say your partnership with Kent, in terms of how your roles and responsibilities are defined. Did it start out that way? Was there a conversation about that when you partnered up? Was there some intentionality about selecting him and him selecting you? And maybe there's some tips in there for folks that are a solopreneur right now that might be looking for a partner to scale their business.
Yeah. Kent and I got really lucky with each other. And that's obviously not good advice to get lucky, but that's the reality. We just got really lucky. We found each other at the right time, and both of our personalities are a good match for each other. Both of us are not too high, not too low, and we're really reasonable. So that is obviously a good match in any situation. But was also a good match was kind of the lack of ego, because we have a few interesting dynamics. Number one, he's substantially older. And so that pushed me to want to work twice as hard and really prove myself given my younger age. And I think one thing that can make partnerships struggle is resentment, because sometimes in a partnership, there might be one person who's working harder or feels like they're bringing more to the table. And then that person will start to resent the other partner. And that's tricky because sometimes you can't measure contribution and sometimes you can't see what everything that's happening. But humility and patience really fixes those issues. So the fact that I had a humility and a willingness to work hard and not worry about that and think, well, it's totally fine if I'm working harder. I'm younger. I need to prove myself. I need to bring something to the table. So I think that was a really good fit where we had, a bit more experience and expertise, and then humility on both sides, frankly. So you can never go wrong with being humble. So that was a good fit between us. One thing that we didn't plan, but this worked out very well, was when we got started together, we both wanted to do deals. We were excited about the real estate and about the deal making and about the nitty gritty. What neither of us really had thought about or were excited about was marketing and sales and raising capital. Neither of us were attracted to that. And we thought we treated it as an afterthought. And obviously we realized at some point that that's not acceptable and you're not going to be successful no matter how good you think you are. If you can't raise money, then you're not going to do deals. So we had to make a move there. And fortunately, I was willing to lean into that spotlight and lean into that role. And my partner, Kent, was totally okay with being behind the scenes. And that is another issue with partnerships that I've seen with other people and some of my friends handling in startups, is handling the spotlight. There's sometimes when you have founding teams or partners and they want to battle it out for who gets the press coverage or who gets the limelight, who gets the recognition, who gets to be on stage, and that can cause resentment. And so fortunately, in our situation, I don't necessarily particularly love being on stage, but it's a necessary thing to do. And my business partner, he loves not being on stage and loves being hidden away. So it's a perfect balance. There's no resentment, there's no conflict. And so I think those are some really powerful ingredients for a successful partnership.
No, that makes a ton of sense. And I think that there's oftentimes a real challenge with, just fundamentally speaking, folks that partner out of convenience or out of like, this is easier or more fun to do with somebody else by my side, but they're not consciously thinking about strengths of, their strengths comparatively to their partner's strengths or their weaknesses comparatively to their partner's weaknesses. And then that's oftentimes discussed, but I really like what you're talking about in terms of the willingness to be the face of the organization in some capacity. Because some people just don't want to do that, where other people really want, they're striving, and that's actually a goal of theirs, and that's what they enjoy from like a personal fulfillment or just an alignment with their personality type, right? Which is, I think that's not oftentimes discussed. We're always talking about complementary strengths, but we're not oftentimes talking about complementary, personality traits. So that's a nice tidbit for everybody out there that's thinking about, especially in the raising capital game, where you really need to be known in the marketplace. And that does require putting your face on camera or walking on a stage or doing the podcast or what have you, because you actually got to get the message out there in a more consistent way, which requires some level of public speaking fundamentally, just at the fundamental level. But, that's great. So speaking of raising capital, let's talk about really what the business looks like today. And maybe we'll get into a little bit of a current events conversation here around specifically what you're doing, Q1 into Q2 of 2023 to raise money. But how do you structure your deals? Who are your typical investors? And how do you think about, deal structuring? And I might have thrown a lot on your plate there. So maybe we tackle the first two. Who are you raising capital from? What types of deals are you doing? And then maybe we can get into structure and you could talk about how you like to structure your deals.
Yeah, plenty to talk about there. So we have a diverse base of investors ranging from individuals such as business owners, doctors, lawyers, things like that. So retail investors is what we call them. And then we also have, I would say, kind of one step up from that would be professional investors or individuals who are pretty, really sophisticated and invest larger amounts. And then we also have co-GP partners or fund-to-fund partners who manage capital and they partner with us to scale up and do larger deals. And then finally, we have what we call our JV equity partners. So these would be more like private equity firms and institutional investors or family offices that are capable of writing majority equity checks for deals. So that could be a 5, 10, 15, $20 million equity check. And those deals are structured more as a joint venture where there's more sharing of control and things like that. So we like to have that diversity because we don't want to be stuck doing one type of deal or doing one type of partnership. So we like to have those options where we can do a syndication and we can bring in lots of different investors, or we can do a joint venture with one of our partners and go do that. So that has been big for us, and we're always looking to build relationships in all of those directions.
Yeah, and I just want to, one more question on that before we continue on some of those other points. Where do you spend most of your time in terms of whether it's networking with specific investors or trying to build the investor base, right? If it's in any specific vertical that you just mentioned, like, would you like to raise capital from a certain profile more so than the others? Do you spread your time evenly across all of those different investor avatars? How do you think about, putting together equity in terms of where you like it to come from?
Yeah, so our strategy, and it's a great topic that we can always improve on, but our strategy is mostly passive when it comes to bringing new investors in. And the reason why is because we create a lot of content, we put a lot of value out there, and then we give people the opportunity to come and reach out to us. And so people reach out, they might be retail investors, high net worth individuals, or a fund of funds manager. And, we're obviously looking to work with anybody. So it just kind of depends on who's coming to us. More proactively, I personally focus more on larger capital sources, and that takes a bit more time, effort, and finesse to build those relationships. And also there's few of them out there, so it's not like it is a numbers game, but there's only so many in your space. So for me, it's about doing the research and networking to find the firms that are the right fit, and then doing my best to get meetings set, and then following up with due diligence information on us, and then sending over deals that we're working on and kind of sharing more about our strategy and just staying top of mind and being willing to take a no and kind of get their feedback and then go on to the next deal. So that's more proactively what I'm currently focused on.
And what do the large JV investors, maybe the hedge funds, the family offices, the private equity groups, maybe it's fair to lump in professional investors into this group. Maybe I'll keep them separate. I'll let you determine that. What are they looking for that retail investors aren't? Or maybe what are some of the due diligence questions they ask that maybe traditional retail investors aren't, in terms of what they are looking for in a sponsor that they are then going to actually invest a large dollar amount with?
Yeah, I'd say it's a lot of the same stuff. Track record is always really important. And it's really important that the track record is supporting the deal at hand. And what I mean by that is if you have a track record in self-storage in Florida, but then you're pitching a multifamily deal in Texas, that's usually not a great fit for an institutional investor, right? They want to see a relevant track record to the deal at hand. Another thing that's really big for institutional investors that isn't really, for the most part, on the radar of retail investors is vertical integration. And we discussed that earlier on in the show, talking about bringing property management in-house and having that focus. Institutional investors really value that, and they like a local partner that's focused, because in their seat, if they're sitting in New York, Chicago, or Newport Beach, and they have a national investment mandate, meaning they can go and invest in multifamily across the country or other asset classes, they would prefer to invest with that sector and geographic expert all around the country. So if they want Florida self-storage, they want the Florida self-storage expert, right? And if they want Texas workforce housing, they want that expert who has the vertical integration. So we try to position ourselves as that expert partner and solution for them, which I think is definitely important if you're going for that JV equity.
Yeah, and that makes a lot of sense. Now let's talk about structuring debt and structuring equity, raising debt and equity. I mean, we can relate this in terms of what you're doing right now as well. I mean, I'd like to ask you at a high level how you approach putting your deals together and maybe why you do it that way. And then the quick follow-up is going to be, has that changed as a result of the interest rate environment as it relates to what the market's been doing? And maybe the answer is no, which is totally fine, right? But how are you thinking about putting deals together right now?
Yeah. So today we're focused on buying deals with decent to strong in-place cash flow, which is a challenge, but finding good deals is always a challenge. And we're coupling that with 7-year Freddie Mac debt. That's our base case, is we're looking for 7-year loans, which we also structure with a 5-year yield maintenance period. So for us, that's become a pretty hot product because it gives you a nice best of both worlds where you have the 7-year term, which is pretty long term, right? That's long term enough to get you through a recession and not have much maturity risk. And then when you couple that with the 5-year yield maintenance period, which means your prepayment penalty only lasts for 5 years. So you can sell after 5 years for zero penalty. So when you look at that, you have a nice combination of long term, but also flexible. Because if we wanted to sell in 3, 4, 5 years, we can and pay a modest to no penalty, which retains our optionality. So, for example, if in 3 years interest rates do go down, we could potentially do a supplemental loan or refinance out of the existing loan or just sell the property and capitalize on a stronger market if it comes. If it doesn't, then we can hold for 5 years, 6 years, 7 years, and then either sell or refi at that point. So on the debt side, that's the sweet spot product. And also it's important to mention that product is a fixed rate product. So the fixed versus floating rate discussion has gotten pretty nuanced and somewhat contentious because some people believe that rates are going to go down, so fixing now is not a good idea. Other people just are tired of the volatility of a floating rate and they just want a fixed rate. And that's kind of more so how we feel, rather than trying to analyze the market perfectly and predict the future and everything. We just feel like a fixed rate, if it works today, it's going to work tomorrow, and it's going just to minimize the variability of outcomes for our deal. And that's what we really want, is we want consistency for our investors. So that's why we're going with the fixed rate. And of course, this is, we've done fixed rate deals like this in the past, but this is definitely different than what we were doing before, because a year or two before, rates were so low and bridge loans were so cheap, it was very tempting to do bridge loans, which allowed us to do larger deals with less equity and also really lever up returns. So the returns looked a lot more attractive. And obviously those days are gone. So we're doing no bridge loans today and no floating rate today. So yeah, the strategy has changed a lot.
No, I think that's kind of, it's interesting because I was talking to an investor who does a decent volume. They primarily invest in Florida. I don't think they've done as much volume as Lone Star has done, but they've done probably 100 million in the last 5 years, about 800, 900 units. And they're still floating their debt right now. And that's their argument is, well, can it really go that much higher? And they're structuring their loan product in such a way to where they have a low floor so that they have some leeway if rates start to come down. And that's part of the negotiation that they have with their lender. And it's just an interesting approach, right? And I think that they're taking the approach of, we're going to over raise. We're really going to, try and maximize what we can raise while still looking at returns on a spreadsheet that makes sense. And we're still going to buy a rate cap, but that's really only going to be if rates really start to continue to run. So it's a minimal cost for that rate cap. But I think it's an interesting conversation now because in the last couple of years, as you mentioned, everybody I shouldn't say everybody, but generally speaking, most people, in order to stay competitive, just floated their rate. Minimal prepay, the rates were low. Why not just do that? And now it's almost like the pendulum has swung so far in the other direction to where if you discuss even a floating rate product, you're like, whoa, people just start to freak out. So I think that it's important to still bring some, kind of nuanced conversation to that decision-making process. And if the end goal is, hey, we're going to hold this property for 7 years and we're underwriting to returns that don't require some kind of cash out refinance in that time period, then yeah, you might as well fix your rate and sleep better at night. I think from a lower stress approach and from an ease of raising capital standpoint, you can pitch minimal downside risk to your investors, and I think it really just depends on strategy. But it's an interesting conversation to be having now. Long story short, now you've also written a book on underwriting multifamily real estate, which I've read. It's a quick read. I highly recommend everybody out there buys it. I think it's underpriced on Amazon, so everybody should go buy that. I'll link it in the show notes. But I want to talk about maybe how your underwriting has changed as well based on the current environment. We know the big levers you pull in underwriting. It's rent growth, your projected rents, your exit cap rate, your debt assumptions. Those are some of the big ones, while there's also some other ones. Has your underwriting changed from an underlying assumption standpoint over the last 3 to 6 months? If so, how has it changed, and how are you looking at underwriting deals right now?
Yeah, I think the fundamentals remain the same. It's right now we're just in a weird market where not much makes sense out there. And somehow there's some people who are still bidding quite competitively. I'd love to see their underwriting.
They're not reassessing property taxes or stuff like that is what I'm seeing, at least in like Florida. It's like, I don't know. Anyways, I interrupted you, but
no, that's a good point. I mean, if you are properly adjusting for your insurance and your taxes and rising payroll and making sure that everything's dialed in, you're putting yourself at a big disadvantage. I mean, you really need to pull some other levers and get excited about the deal in some other ways to make the deal make sense. Otherwise, you're just going to pass on every deal. And of course, our business is not to pass on every deal. We want to find good deals in all parts of the market. And right now it's especially difficult. So for us, I think some of the ways where we can get a little more aggressive or creative is we can really focus on strong submarkets with good growth. That way we can afford or feel more comfortable projecting stronger rent growth. Of course, stronger rent growth, that's a big impact on returns. And then you also mentioned exit cap rate. There's not much creativity on exit cap rate. You push it down, returns go up. You increase it, returns go down. So that for us is just, how aggressive can we get on the exit cap while still feeling okay and safe, and that if we're wrong on that by 50 basis points, are we still hitting double digit returns? Because if that's the case, then that's still a strong deal. So those are the things that we're looking at. And I'd say underwriting wise, this isn't necessarily changed, but strategy wise, we're really looking for deals that underwrite to strong in-place cash flow, because today every basis point of going in cap rate matters, because we are financing based on in-place income. Like we were talking about a year plus ago, when we were borrowing bridge loans, the lender wasn't basing the loan based on the in-place performance of the property. However, with us pursuing fixed rate long-term debt, that's exactly how the lender looks at it. They look at the in-place income, and the deal is actually constrained by the in-place income as far as how much loan dollars the deal can support. So for us, it's like a double whammy, because if you buy a deal at a low cap rate today, you're going to get less cash flow, but also lower loan amount, which is going to lever up your returns less. And so your projected returns are lower because you're getting less leverage. And now you have to go raise more equity at lower returns. So obviously we don't want to be over levered, but if we can buy deals at 5 cap plus, we can borrow a decent amount of leverage, call it 60% leverage plus, which is where we want to be.
And that makes a ton of sense, because, we see it in our business right now where, we primarily do moderate to heavy value add deals, and we don't want to go the bridge debt route for the reasons that everybody discusses, but we run into constant issues with our DSCR being constrained at purchase when we're going, whether it's a Fannie Mae or Freddie Mac, we're bidding a deal out, or it's a larger loan for a local bank or credit union. It's just, that's the challenge, right? So now we have to balance raising excessive equity today, because we just can't put that much debt on the property based on its in-place financials, which is, you're right. I don't think that many folks have had that battle the last few years where it's just bridge, and it's all LTC. which creates some interesting dynamics. Now, I would make the assumption, and again, correct me if I'm wrong, right? I'm not behind the scenes in your business, but I would make the assumption that by structuring your deals with 7-year fixed rate debt, and relatively speaking, comparatively to the last few years, a lower LTV going in, that your projected returns are a little bit lower than they have been, in the past years, however you want to define that. One, assuming that's the case, and again, correct me if I'm wrong, has that made raising capital more challenging for you? Have you dealt with issues recalibrating investor expectations? If so, how have you kind of navigated those conversations as you continue to raise money for deals now?
Yeah. Recalibrating investor expectations is very difficult. It takes a long time because investors get habituated to certain results. And so we've seen a very strong cycle over the last 10 years where investors have earned very strong returns. And that biases those investors to those strong returns, right? If they just got an exit done and that exit is a 30-40% IRR, then investing in a deal that's projecting a 14% IRR is just not attractive. So that's really tough. I would say that we just, we have our work cut out and we just work through it. One thing that's a bright spot is, or I should say, our 1031 exchange investors, because 1031 exchange investors are investors with a deadline, and they obviously want to invest in a good deal, but they also have tax concerns as well. So the deal becomes not the sole thing they're focused on. So we've had success with 1031 exchange investors coming in on deals, and that's been a big win. I think that will continue to be a big win over the next year or so, because right now transaction activity is way down. So sure, that might mean less people are exchanging, but it also means of the people that are exchanging, there's not that many options for them to go into on the next deal. So for us to have a deal ready to go and able for them to come in at, and we can confidently make it happen for them, that's only going to get more attractive. So we're seeing that happen. But what we need to stress, and what we've been stressing, is risk. If you're talking about lower returns, they need to be matched with lower risk, because there's no sense in projecting or shooting for lower returns if the risk profile is the same or it hasn't changed. So if you look at the deals we're doing today, it's a different risk profile. We're focusing on deals with less value add, potentially less upside, more in-place cash flow, as well as less leverage and long-term leverage. That's a very different risk profile. So it's okay if the returns are a little bit lower, but that risk conversation is very difficult to have because the average investor only really thinks about numbers. You show them two deals, 15% return, 20% return. It's hard for them to actually look at those through a risk lens and say, well, the 15% deal is actually better if I factor it the risk.
Yeah, and it's not been a conversation recently. I mean, risk-adjusted returns is a nuanced component of raising money or communicating a deal and its merits and its projected returns, specifically to retail investors, I think, that are maybe, writing the smaller checks and are newer to this type of investing, and they maybe get wrapped up in, what the OM says, right? Comparatively to folks that have been in this game for a while, whether it's professional investors. And I imagine, for example, your joint venture equity partners, this is a significant component of their decision-making process, is how do these returns align with the risk profile of the deal? Again, just an assumption that I'm making, but I think that's, it's a challenge we're having in our business. I think everybody's dealing with it at some extent. So that all makes sense. But I do want to talk about your 1031 exchange solutions, right, for investors. How, and we might get a little tactical here in terms of how you actually do this, but one misconception in the marketplace: you can't turn 31 into a syndication, right? So first, disprove that. Maybe talk about the structure that you use, and then we can get into like timeline. Like, this is exactly how we put it together, and this is what happens behind the scenes from a sponsor standpoint.
Sure, yeah. So the way that we facilitate a 1031 exchange with us is through a tenancy in common, and so this TIC structure allows us to actually bring 1031 exchange investors into the deal technically side by side with the syndication. So technically speaking, yes, you can't 1031 exchange into a syndication, but you can 1031 exchange into a deal that is being syndicated by a sponsor. And so just to get into the org chart, the way that would work is we have the deal itself and we have our syndication entity, which will be, the deal limited partnership. And then the tenancy in common means that there's multiple direct owners of the real estate. And that is a key component to satisfying a 1031 exchange, which is that you have to do a like kind exchange. And if you sell real property, you have to exchange into real property. And unfortunately, when you invest in a syndication, you actually are not investing in real property, you're investing into a partnership interest. So thankfully, through the TIC structure, we're able to have the 1031 exchange investor come in, take ownership of the real property directly, and then we do some things on the back end to structure that out so that the lender's happy, we're happy, the investor's happy. There's a lot of moving parts there, but I'll just throw out one nuance, which is since their entity is a direct owner of the real estate, the lender recognizes them as a borrower. And that's where the complications come, because now all of a sudden your exchange investor may be asked to sign on the loan and to provide financials and things like that. And so we try to protect our investors from that as much as possible, do as much of that work for them as possible, and structure around that. And so there's negotiations with the lender to minimize the work and exposure of our investors.
No, that's we could probably spend a long time on this, but I have maybe one or two more follow-ups because I think people listening are really interested in the mechanics of this, right? Maybe talk about how the waterfall works or how distributions work. Because again, I think that, since you're going from dirt to dirt, real property to real property, is there a pref and some kind of split assigned to this investor that's coming in as a tenant in common, right? And actually, they're on the deed, or how do you structure that with a syndication entity where you've raised capital from a bunch of retail partners, maybe you got a big 1031 investor, and that's how you're capitalizing the deal. What actually happens when it comes time to make those distributions, pay out the pref, you sell it, you pay out the promoter, what have you?
Yeah. And there's many different ways to structure this. And, I'm sure ours is different than others, but the way that we have it set up, and I think this is the cleanest way, is we are a manager. We join the 1031 exchange investor in their entity as a manager of their entity. And what that means is within the operating agreement of that entity that is doing the 1031 exchange, we're able to structure fees and a waterfall in that entity directly. So that way there's not TIC across TIC, cross entity or TIC agreement. I mean, there is a TIC agreement, but we don't have to outline those sorts of things in the TIC agreement. It can actually be done inside the entity itself because we're a non-member manager. The other benefits of being a non-member manager is that we're able to sign on the loan on behalf of that entity, right? Because the lender wants someone to sign. And if we're a manager, then we're eligible to sign on behalf. And that's great because then the 1031 exchange investor doesn't need to sign on the loan, which obviously if we can avoid it for them, that's great. However, we have some investors who don't want to give up the management of their entity, right? They don't want that. And so that's where things get more complicated, where they are the manager. And so we try to negotiate with the lender to carve out their exposures of the guarantee. They might still have to sign the loan, but maybe their bad boy carve outs are only related to bad acts on their own, right? So that they're not liable for other loan guarantor bad acts, right? Because so we just try to work to minimize their exposure, like I said.
Yeah, no, that's interesting. And it certainly gets you into a situation where you're knocking down a lot of the common objections to structuring deals in that way, where it's like, I think it's easy to just hit a wall, right? And to not be able to get past a lot of these different things. And therefore people just shy away from taking 1031 funds, but it's understanding the mechanics that allow it to work and kind of working through that process. Now, you've had a lot of success the last 5 years, grown a hell of a business. You guys are doing obviously incredible volume now. And, between the books, the platform you developed, all great things. Now let's talk about maybe some things that haven't gone as planned. Is there a deal or some kind of lesson that you've learned along the way here that you feel comfortable sharing? just to give some folks maybe a learning takeaway in terms of something to avoid as they try and scale at the rate that you have and get into the types of deals that you're currently doing.
Yeah. So just broadly speaking, without bringing up any specifics, I would say that being prepared is really important. And specifically, it's being prepared before you have the deal under contract. Because once the deal's under contract, there's so much to do. There's due diligence and different negotiations. You have to raise the capital, you have to get the debt. So there's so much work once the deal's under contract. It's a shame to also leave the work in there that could have been done prior to being under contract. And so that was a mistake that we made with our first deal, actually. And so going back to that, if you are chasing a deal, there's nothing stopping you before you even have the deal to identify a property management partner and make sure you vet them and do proper due diligence. There's nothing stopping you from lining up your loan guarantor, because more often than not, for your first deal at least, you're going to need a loan guarantor. And you don't want to have a deal under contract and have time ticking and you're out there trying to find a loan guarantor, right? That's just, there's no need for that. It's better if you can do that outside of that deadline. So those are just a few things that come to mind as far as being prepared. But a big one is also equity. A lot of people, myself included, when we were starting out, is we spent no time or energy on building relationships with investors and trying to raise equity before we got our first deal under contract. And then, of course, we were fortunate not to learn the lesson the super hard way, but we learned it with a pretty hard way, right? We had a really tough time raising capital. We underestimated the difficulty of it. And so that's why it's so much better to be planning ahead and really building that pipeline and relationships and process prior to having a deal, which is tough because people reach out and they ask me, well, how do I do that? If I don't have a deal to pitch, how do I entice investors, or how do I talk to investors, right? And there's a few ways to go around it. You can get a sample deal, or you can partner with someone at first and be a co-GP and get exposure into a deal that way and use that as your talking point. So there's no excuse. You just have to kind of jump in one way or the other.
Yeah, and that makes a lot of sense. I mean, the challenge I think people have is exactly what you mentioned, where it's really hard to raise money if you don't already have the track record or the network of folks that know, like, can trust you. So naturally, you just end up spending more of your time on looking for the deal, because that doesn't require the network, doesn't really require the track record. I mean, it does, I guess. You need some level of a track record to be awarded a deal in a brokerage scenario. But yeah, and then they get the deal, and then they forget that the mantra that everybody seems to kind of reiterate online, that's just not true, is when you have a great deal, the money will find you, which is total BS and garbage. And maybe if you have a great deal, the person that can help you raise the money will step up, but it's not like the investors are going to invest directly with you if you haven't already had those conversations. And this is critical, even more critical now, is it's harder to raise money now than it was 2 years ago, right? Where everybody's gung-ho, there's all the liquidity in the marketplace, crypto stocks through the moon, everybody's cashing out, throwing their money into hard assets, low interest rates. Like, this is hard now. So if you're going to spend more time on one side of the business, whether it's deals or money, it should be money now if you don't already have that pretty well developed. And on that note, and we can kind of wind down the episode with this, for the folks out there that, maybe they can raise a couple $100,000, but like, it's the friends and family. They're not really getting into a position where they're bringing in significant amounts of capital or enough capital to get into a sizable deal. What are a couple of the first steps you recommend somebody takes in order to start building that initial list in order to actually go to that pool when they do have that deal under contract?
Yeah, I would build your list and your funnel in reverse. I would focus on what is the bottom, what is the end goal? And the end goal may be to have an investor invest with you. And then think, okay, well, what's the step immediately preceding that? And that could be a phone call with you, right? Okay, so now okay, my goal is to have as many phone calls as possible where people are ready to invest. Okay, how do you get them to a phone call, right? And then just kind of unpack your funnel from there. And so to take it the next few steps, I would say, okay, well, if I need a phone call, I need to figure out a way to attract people to a phone call. And that might be by having a form on your website for potential investors to fill out. And that's how you get in touch with them. But you have to understand that the work there is not done because most people aren't ready and warm enough to just fill out a form and schedule a call. So maybe they're willing to fill out a form, but they're not willing to schedule a call. Okay, well, you have a gap there and you need to figure out how to add enough value and build enough trust to bridge that gap. And so that might be through content or through, a first, or like through your calling them and then trying to schedule a more formal due diligence call later. And speaking of content, I think something that is great and really I'm thankful that I did very early on was start a newsletter. I think you need to have consistent communication with your investors. Otherwise, you're not top of mind and you're going to lose them. And all that hard work you put into finding new people and building new relationships is going to go to waste. So definitely having a newsletter, whether that be weekly, monthly. I do think monthly is probably the best because it's less work than weekly, right? But it's still enough to be top of mind. So I like a monthly newsletter. And then finally, you need content to put yourself out there at the top of funnel to give yourself the opportunity to get exposure to people who don't know you. That's the key. And that can be done in so many ways, like we talked about earlier, as far as being on a stage or hosting or guesting on a podcast, contributing to social media and networking forums and things like that. There's so many ways to do it. And really the challenge is sticking to it because you're not going to see any results for a while and you have to just stick with it.
100%. It's a slow burn. It's not easy. But yeah, I mean, fundamentally, just getting out there telling your story, right? You have to reach multiple people at one time, right? So it's like, what can I do that's scalable? No, the email newsletter is scalable. Posting on Instagram or Facebook is quote unquote scalable. And you have to start doing that and then slowly start building out the foundation and then attracting people in terms of people coming to you, getting to your website, booking the call, adding their email to your list, all of these different things that allow us to get to that first 10, 15, 20 investors, which is really where the snowball starts to snowball. You get to that first, dozen, 2 dozen, you do right by them and get a referral or two. And next thing you know, you're in a position where you can actually put together enough capital to buy a sizable deal. But it takes some time to get there, right? And it's just baby steps. But Rob, this has been great, man. I really appreciate you taking the time. I'm going to plug feel free to plug your books here, right? I know that you probably will. I'm going to include them in the show notes. And then include any other, anything else that you'd like to share and maybe where people can get in touch with you.
Yeah, thank you so much for that. So if people want to learn more about myself and Lone Star Capital, you can head to our website, which is lscre.com. On our website, we've got some great resources. We have a free download of our underwriting model that we use to analyze deals every day. And that goes really well with the book that we talked about that I wrote a couple years ago about underwriting multifamily, which thank you. You'll have a link in there that's available either on our website or on Amazon. So please go ahead and check that out.
Awesome. Well, thanks again for the time, man. This has been great.
Yep. Thank you.
Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review as it helps the show get noticed by more folks. Catch you next week.